Hello and welcome. Today, with the help of the experts at My Tax Accountant, we're going to pull back the curtain on something that affects millions of us. How much does HMRC really know about the money you earn outside of your main job? Well, the answer might just surprise you. It's probably a lot more than you think.
So you've got a side hustle, some savings ticking away, maybe a rental property. It's easy to think that extra income just, flies under the radar. But in today's digital world, is anything really a secret? As we're about to find out, HMRC's view of your finances is becoming crystal clear. You see, the systems that HMRC uses now are incredibly connected, and they're all automated. They're constantly building this surprisingly detailed picture of your entire financial life. So let's break down exactly how they do it, piece by piece. All right, here's our roadmap for this discussion. We're going to start with the most direct link to your money, your bank account. Then we'll get into your digital footprint from the gig economy, uncover how data is shared globally, and meet HMRC's powerful digital detective, a system called Connect. And importantly, we'll finish up with the practical steps you can take to make sure you're fully compliant. Okay, first up, let's talk about the most fundamental connection of all. When it comes to the interest you earn on your savings, it's not really a question of if HMRC will find out. It's a fully automated yearly process that leaves absolutely no room for doubt. At the very heart of this is a system that most people have never heard of. It's called the Bank and Building Society Interest Returns, or BBSI for short. And the rule is simple but incredibly powerful. Every single bank, every building society in the UK has a legal duty to report the gross interest they've paid you directly to HMRC. This isn't optional for them. It's the law. And this whole process runs like clockwork, every single year. You can see how it works for the 2025/26 tax year. HMRC formally requests the data late in the tax year, and by June 30th, just after the year ends, your bank has sent over all the details. HMRC then uses this info to double-check your tax return, or, and this is clever, they might even adjust your tax code automatically if they spot interest you haven't declared.
Now, here is a crucial pro tip, because this is where a lot of people get tripped up. You've probably heard of the personal savings allowance. For the 2025/26 tax year, it means basic rate taxpayers can earn up to $1,000 in interest tax-free. Higher rate taxpayers get £500. So a common myth is, well, if I earn less than that, the bank doesn't need to report it, right? Wrong. That's not true at all. The bank reports your total interest, no matter how small. It's HMRC's job to apply the allowance later. So the key takeaway here is, just because it's tax-free doesn't mean it's invisible. All right, so we know your bank is talking to HMRC. But what about all the other ways we earn money now? The whole world of work has changed, which brings us to your digital footprint. If you earn money through an online platform, your activity is now a direct data feed to the taxman. And stay with me here. This next point might really surprise you. Since the start of 2024, brand new rules kicked in that require all these digital platforms to collect and report how much their users are earning directly to HMRC. So imagine Chloe, a freelance designer in London, and she's selling her amazing art prints on Etsy. Well, Etsy is now legally obligated to tell HMRC about her income once she hits a certain point. It's no longer just on Chloe to declare it. That data is now sent automatically. So what are these triggers? Well, it depends on what you're doing. If you're providing a service, that means renting out a room on Airbnb, driving for Uber, or doing jobs on Fiverr, the platform has to report all of your earnings. There's no minimum threshold at all. But if you're selling goods, say on eBay or Vinted, the trigger's a bit different. They'll report you if you make over about £1,700, or if you complete 30 or more sales in a year. The big thing to grasp here is that even pretty small-scale selling is now officially on HMRC's radar.
And here we go again with another pro tip, and it follows exactly the same logic as the savings allowance. You see, there's a £1,000 tax-free trading allowance for side hustles, which is great. But, and you can probably guess what's coming, a lot of people assume if they earn less than that, the platform won't report it. And that's a mistake. The platform reports your total earnings, regardless. It's on you to then claim that allowance on your tax return. The pattern is crystal clear. Reporting happens first, allowances come second. So far, we've only talked about money earned here in the UK. But that's not the whole story. Not by a long shot. In today's completely interconnected world, those financial borders you think exist, they're becoming more and more transparent. And that gives HMRC a surprisingly clear global view of your finances. How is that possible? Well, it's because of something called the Common Reporting Standard, or CRS. Think of it as a global pact.
Over 100 countries have signed up and agreed to automatically share financial data with each other to clamp down on tax evasion. So for example, let's say you're a UK resident, but you have a bank account over in Spain. Well, that Spanish bank is now required to send all your account details to the Spanish tax authority, who then automatically forwards that information straight to, you guessed it, HMRC. And the level of detail they share is just incredible. I mean, we're not just talking about your name and account number. They report your total account balance, every bit of interest or dividend you've earned, and even the gross proceeds if you sell assets. The whole system is designed to paint a complete financial picture, which makes it very, very difficult for any offshore income to go unnoticed. Okay, let's just pause for a second. We've got data flowing in from every UK bank, from all the digital platforms, and from financial institutions all over the world. How on earth does HMRC process this absolute ocean of information? Well, that brings us to their powerful secret weapon. It's a system called Connect. And this isn't a person. It's a massively sophisticated data crunching machine. The best way to think of it is as a digital super detective. It sifts through billions, literally billions of data points every year, and it's looking for patterns, connections, and things that just don't add up. Its main job? To spot a mismatch between the income you declare and the lifestyle you appear to be living. This Connect system is the central hub. It's the brain that weaves all those different threads of data together into one big web. It takes the bank interest data, the reports from digital platforms, the information from the global exchange, and it cross-references every last bit against your tax records to see what stands out. And the variety of sources it can pull from is just astounding. It's not just tax and bank data. We're talking land registry records to see if you own a property you aren't declaring rent from. It pulls DVLA records to see if the luxury car you just bought matches your salary. It can even scan publicly available information. And yes, that includes your social media posts. It builds a complete person profile from dozens of places you'd never even think of. Now, I know, hearing all of that can feel a bit daunting, especially if you're now thinking, hang on, I might have some undeclared income from a few years back. But look, the goal here isn't to scare you, it's to inform you. So let's switch gears from how they know to what you can do about it. And this is the most crucial point. There is a massive difference between waiting to get caught and coming forward voluntarily. If HMRC opens an investigation and finds undeclared income, the penalties can be really severe. We're talking up to 100% of the tax you owed, and sometimes even more. But if you are proactive and you disclose it through an official scheme, the penalties are drastically reduced. Being proactive is always the better financial choice. And the good news is, the path to getting things right is actually a very clear, structured process. First, you notify HMRC that you want to make a disclosure. That starts a 90-day clock. During that time, step 2 is to calculate exactly what's owed. Step 3, you make the formal disclosure and pay the tax. And the final and most important step is to get it right from then on by making sure you're registered for self-assessment and declaring everything each year. Now, before we finish up, a quick but very important point. The information we've shared in this discussion is for general guidance only. You shouldn't rely on it to make financial decisions because tax law is incredibly complex and everyone's situation is unique. And for that exact reason, you really must consult a qualified tax expert. If anything we've talked about today has raised concerns for you, the absolute best course of action is to get professional advice. The team at My Tax Accountant are specialists in this area. You can reach them by phone on 0208 570 8531, or you can email them at info@mytaxaccountant.co.uk. Thank you so much for joining us.